Hey, good afternoon. Today, I've got one easy tip for you to increase your long-term investment returns, and that is to shift more of your investments towards value stocks and out of growth stocks. Now, this is for those that are looking to save long term. If you're looking to keep your money safe, if you don't want to take a lot of risks, then you don't want to put your money in stocks, right? You don't want your money in the stock market because it goes up and down. But if you are investing for the long term, value is going to outperform growth over the next several years. And that rotation is already starting. The reason that I recommend this is because right now we are seeing a change. We're seeing a shift from all those high-flying technology stocks into value stocks. And value is primarily in those needs-based businesses. Now, I've recommended this before on videos with you when we've talked about it, but sectors like agriculture, energy, healthcare, utilities, consumer staples, those sectors are going to do better, especially if they're businesses that are established, that bring value to their customers, and that have strong pricing power. Those are the companies you want to be invested in. And they still have a long way to run. Some of them have done well over the last year, but they're going to do even better over the next several years. The reason why growth stocks won't do as well is because growth is not something that is necessarily established yet, right? So for instance, I'm going to mention a few stocks, but these aren't endorsements to buy these. I don't own them, and I'm not recommending that you buy them, but I'm just using them as examples. I've frequently had acquaintances or colleagues of mine who are financial advisors say, hey, you need to buy Zoom, or you need to buy Ring Central, right? Ring Central stock has not done a profit. They've not been profitable in the last 3 to 4 years, right? It's all been a hype on, hey, this thing is going to go up. It's going to bring us a technology that we've never seen before or that other competitors don't provide. And really what you see is you see a stock go into a bubble and then crash. And that's what a lot of technology stocks are doing. The reason why is if you're not producing a return right away, when inflation goes up, when interest rates go up, that return that you're expecting in the future is further and further away because the cost of investing now is a lot more expensive than it was when interest rates were lower. I know some of this is kind of complicated, but what I want to do is I want to emphasize with you that being the first mover, right, being someone who moves into these stocks earlier rather than later, it's when you're going to see your biggest gains. That's why it's such an easy tip, but it's hard to do for a lot of people because they're trapped inside what they already know. They're trapped inside, hey, I've done well in something and I think it's going to come back, or it was higher at one point, and it's very hard to break that paradigm to get you to be willing to invest in stuff that's really more value-based and not growth or speculative. So for those that are interested, please focus on, if you're able to invest in value, that is something that is going to do much better over the next several years. For active duty military or for those invested in the TSP, one area you might consider shifting would be a little bit more in the I fund, the international fund, due to the fact that a lot of those stocks are closer to earth. They're more fairly valued than U.S. stocks are because U.S. stocks have much farther to fall, at least the growth do. And if you're positioned in the right way, especially if you do it early, you're going to realize your greatest gains over the long term. Please post a question or comment. Send me a private message if you want to talk about it privately. I always enjoy reading your comments. And until next time, I wish you unlimited success.